Let's put the focus on, financials business, right? Very high quality financials business, highly rated, and, business which most investors love to own. I'm talking about Chola Finance. And we've got the management now joining us. Arul Selvan is President and Chief Financial Officer of the business. Mr. Selvan, good morning. Great to have you with us here. Thank you for your time. Prashant this side. We're on the cusp of rate cuts, sir. Rates went in globally 0 to 5% in the US, and now they are going to come down, at least 75 to 100, if not more, basis points this year. Although in India, if you talk to money market folks and economists, etc., the first cut is only in December. So there is a bit of a gap when we start to see rate cuts here. Just your thoughts, Mr. Selvan. For your business, what do lower rates mean? What's the profile of your liability book in terms of maturity? How fast can you reprice? And I also believe that you recently raised some money, right? At a 9.5 coupon rate, 9.5%. So if you can just sort of contextualize that with what you see going forward. Go on.
Yeah. The recent raise which you referred to as the 9.5 is a perpetual debt, and that's a Tier 2 capital. So that's not the normal rate we raise money for our normal borrowings. The better reference would be the ECP loan which we did recently, which is also in the news, which is at around landed cost of around 8.3 fully hedged. Coming to the rate cut part of the discussion, that is, we need to see how RBI reacts to what the US drop is, how is it getting translated in the Indian context. Yes, if it does follow suit, which I think would be more in Q4 rather than even in Q3, then yes, it would benefit us. We would prefer or we would love to have a earlier rate cut, but my guess would be it would be a little later because we still have the overhang of the inflation to address, and RBI may take its time to follow the rate cut, at least with a lag of a quarter or so. But if it does so, then yes, almost I would say, because a large part of our bank borrowings are indexed on EBLR, which is a benchmark to the indices rather than to the MCLR. We would see the benefit translating into NIM improvements as we move into the subsequent quarters. We should have a NIM improvement coming through if there are rate cuts.
So what percentage of your liability side is benchmarked to these on the EBLR side? And because even if RBI only cuts in December, expectation is because the interest rate differential will be very large. A lot of money will come into debt markets, into government bonds, etc., and that should lower some of these indicators to which you're also tied to on the liability side. Could you give us a sense of your liability profile and how will that impact? Wouldn't you pass it through those so directly? So will there be any improvement really? Go on.
Yeah, so to give you the breakup of the liability side, nearly 50% of our borrowings are from banks, of which I would say are almost 60-65% is benchmarked with the indices. So that would translate in, with at least with a month lag or at most a quarter lag. So that would come through. Now, the other point you raised about the markets pricing the reduction, yes, they will do, but that would only impact the incremental marginal borrowings from the market. Whatever we have done in the market on the NCD front, which I would say the market borrowings right now would be in the range of around 20 to 25%, that would not get altered because most of my NCD borrowings are fixed rate borrowings, so they will not change. So that would continue to be at the same levels and has to be run down. That's where I said if we would only get around 50% of the rate cut, broadly coming through, which will translate on fresh borrowings from the market plus the repricing of the existing borrowings from the banks.
So two-part question.
We have
right. Go ahead.
Sorry. No, we have securitization book. which would also get some of them will get repriced, some of them are on fixed rates. And then the ECBs, we are seeing the rates coming down. That's why we did a large ECB even just this week back. We got 300 million coming in, and we have a few more lined up. So those things would benefit us as we see rate cuts happening.
So, on this itself, I just had a two-part question. One, you said that your NIMs could see a positive improvement. If you could give us a sense of by how many basis points, would it be 10, 20, 30, 50 basis points? They've been between the 7 to 8% mark for a while. And the second part is on your, loans itself. How is offtake right now, and at what rate or what yield are these offtakes versus the older books?
See, that's where I said we will, whatever is the rate cut that is happening, we would see a benefit of almost 40 to 50% of that coming through over the next quarter. So if there's a 25 basis point cut, we should see a 10 to 12 basis points, improvement in NIM. This is purely, or I would rather not even say improvement in NIM. I would rather say it is a reduction in cost of funds. Whereas, how much of this will get passed out to our customers would also reflect, because on the proportion of the fixed book versus the floating book. On the fixed book, which is, almost 58% of our book, which is vehicle finance, is fixed. There we may not have to pass on because that we like how we absorbed the rate increase during the period when the prices went up or the interest rate went up. Now is a scenario where we may benefit when the rate cut happens and that book remains fixed. But on the mortgage business, we will have to pass it on depending on how the market pans out and how much rate cut that we get, and how much of that tenor based is linked to each of these mortgage business loans, and that we would be passing on. So there may be some reduction. So net, that's where I'm seeing around 40 to 50% of the rate cut would sort of reflect in our NIMs.
And your offtake, the yield differential between your previous loans and the current loans that you're giving, because the street believes that you are giving out newer loans at slightly higher prices as well.
Yes, see, that is a result of two things. One, the change in the pricing. The other is the mix in the product. The product mix also is changing. So when there is a large rate increase happening, we move out of low yield products like heavy commercial vehicle, for example, and then focus on higher yield products, because at that rate level it is not viable to reach our return on total assets, the ROTA, that we would be targeting to achieve. So we slow down on heavies. If you observe, we would have slowed down over the last 2 years from almost 6-7% of the overall vehicle finance AUM. It has come down to around 4% now. So we slow down on that and then focus on other areas like two-wheelers, tractors, three-wheelers, which are of higher yield. So the mix change also results in yield improvement. So it's not like a straight, simple, vanilla one product company where you can track it exactly how much all of the yield increase is attributable to the price change only.
Yeah. So all things put together, Mr. Selvan, really appreciate you being very granular, because these things are complex, right? I mean, you have the liability side and see how much that gets repriced down, and there is the asset side, and there the mix really matters. All things put together, margins for the company have been between the 7 to 8% band, right? You were in the middle of the band as of the first quarter. Because we're in a softer rate cycle, and in all probability we'll see rates head lower here in India as well, should one assume that you can perhaps end the year closer to 8% on the net interest margin? Would that be a fair assumption to make?
I would say let the rate cuts happen, and then I will give you this commitment, because, we are building on assumptions here that, yes, I know they are looking more factual, but we, as you know, we are a very conservative company. We try to commit only when, we see things happening, in reality. Otherwise, if I just, people will forget that it is conditional to the rate cut, and then they will hold me to the 8% mark. So I would
fair point, sir. No. We understand. I mean, these are nuances that one has to take into account. So let the rate cuts happen. Let the RBI project its path. Right now, we're only dealing with the Fed's path. So completely take your point. On the subject of growth itself, I think in our earlier conversation, you did mention that, on a steady state basis, you would look to grow the book by at least 25% every year. But looking at the second half, now I just want a more of a here and now projection. Second half, CVs, from what we see in the numbers, I mean, there is no pickup as yet. The business still seems to be flat. So what will be the credit growth drivers for you? And also just tell us about the new business, because the market believes that could fetch you higher yields. So just tell us about that mix, where the focus will be and where the growth numbers will come in the second half.
Surely. Even in auto, we have been shifting from the new vehicles to used vehicles, and used vehicle demands is really, robust, I would say. And so we are able to still clock at around anywhere between 10 to 15% growth in the vehicle finance book, which on a larger base translates into a large absolute number. The focus, of course, is to grow the mortgage businesses, which is the LAP and the home loans, which would actually grow above the 30% mark over the next at least 2 quarters, if everything pans out well and the rates remain robust and the rate cut does really translate into reality. The new businesses which we introduced over the last 3 years, which is SME, CSEL and SBPL, they will also grow faster, albeit on a lower base because they are very small right now. All three put together less than 15% of the overall book. So while the growth percentage will look larger, but their absolute incremental addition to the overall AUM will remain, still a smaller number to go by.
Got that. Mr. Selvan, very briefly, if you can give me a 30-second response to this. You did mention ECBs a few times. Will you go in for that route more? And why is that? You can do it because you're rated as you are. Many NBFCs cannot. Is the liquidity condition still quite tight locally?
No, look, see, for me, the benchmark is which gives me the lowest rate.
Okay.
Because there is a easing of the forward rates, and in ACBs, our guidance from the board is to completely hedge it, both principal and interest. So I look at it at the landed cost. If the landed cost is comparable to the local market or better, I go for it.
All right.
So we are selective about the ECBs. We try to do only through banks which have got presence in GIFT City, so we can not get impacted by the withholding tax, etc. So we are very selective, and our spreads over so far which we give have been negotiated tightly. So our landed price in all the ECBs we did so far is lower than the local domestic market pricing.
Oh, wonderful. Thank you very much. Appreciate you joining us, Mr. Selvan, and we'll speak again soon. Thank you.